Hello and welcome to the National Fintech Organization and this second installment in the series NFO's Growth Garage, Get Smart and Get Connected. Today, we'll hear from Sam Kilmer of Cornerstone Advisors and his 5 success factors helping fintechs win the highest value client and partner deals. All attendees are in listen-only mode, but the chat feature is available at the bottom of the window for comments and questions. Please give it a try now and let everyone know what part of the world you're connecting from. And as we go along, add your questions for Sam. This session is being recorded and will be available on demand within the next few days on the NFO's YouTube channel. And now, I'd like to hand it over to Mike Alice with FIS to introduce our speaker. Mike?
Thank you very much. Hey, welcome everybody. I'm glad that you guys could all join us. I'm super excited for this NFO Growth Garage event today and to hear from Sam. I'm with FIS. FIS is a large fintech organization that's been around for about 50 years. Serving banks and credit unions and a whole bunch of other industries as well. So FIS is really thrilled to be able to support the NFO and the resources and education it can provide to all of us within the fintech industry so that we enjoy our jobs more and do our jobs better, that we're more successful, and frankly, at the end of the day, that we serve our clients better. So super excited that you've joined. Welcome. I'm very thrilled to hear what Sam is going to share today. I've been for about 25 years now in different sales and sales leadership positions in the fintech industry. And I've learned over and over and over again the benefit of our networks and learning from each other and sharing best practices with each other. And Sam and Cornerstone really have a unique perspective in all the deals and activity that they get to see. So Sam really is going to be able to share with us a lot of his wisdom and intelligence from all that they see, which I think can benefit all of us in our careers and our jobs as well. So thank you all for joining. We appreciate you being here. And Sam, you can take the ball.
All right, thanks, Mike. Appreciate it. Good to be with everyone today, and thanks for the invitation from the National Fintech Organization to join you today. I'm going to share my screen now. Hopefully you can see that okay. Let's see here. This is the part of the session where we test the consultant skills to make sure that they can work PowerPoint appropriately. Always my favorite part of the session. But good to be with you today, and I'm going to take you through some success factors that the NFO asked me to put together from our work with investors in fintech, as well as fintech organizations, both challenger fintechs, as well as sort of more mature fintech organizations like FIS and Mike's team as well, and then also with a few hundred bank engagements every year, and so many banks plowing headstrong into fintech, and such a strategic topic. So at that intersection, we're going to plan on covering a few topics today. We'll get it to 5. One of the things I'll find interesting to watch in the chat, and I'm going to ask Mike to help me with that too, is just seeing some of your perspectives on some success factors too. We don't have all the answers here. I'm going to give you my top 5, but there's probably a 6 through 10 or maybe even 100 out there. But good to be with you, everybody, today. So let's just jump right in. These are my perspectives. I have to live up to them, but also I come from a team. So my background is the teams that I've been on before is I led digital banking for a mid-sized bank in my career, where fintech and integrating different systems was a big part of things. I spent the majority of my career working for a fintech provider in the space, started out in implementations, then went to interfaces, and then went to partnerships, and ultimately mergers and acquisition work, and then have been for the last 10 years with Cornerstone Advisors. And this is very much a team effort. We are coming to you not just with the Sam Kilmer show here, but the Cornerstone Advisors show. So we're coming to you from Scottsdale, Arizona, and Raleigh, North Carolina, and all points in between. I happen to be based here in Indianapolis, Indiana. But we're sharing some perspectives from the broader team and our research as well. So that's a little bit about me and a little bit about Cornerstone. Let's talk a little bit about success factors. And I think one of the things that we're used to thinking about when we go into discussions of deals, whether it's in commercial lending, treasury deals for banks, or deal making for investors whether it's investors of a bank, investors of fintech, there's some universals. One of the universals I think that we tend to think of when we think of deal making is the age-old sort of Wolf of Wall Street deal making of charismatic salesmanship of sell me this pen, sell me this pen. And I think many of you recognize this from Wolf of Wall Street and Leo DiCaprio's role in playing Jordan Belfort here, in this whole idea of, can we simply, through our sheer will and charisma, will this deal to happen? And I'll go on record here as saying it may have been dead for a few years, but I'm a big believer that the Rainmaker that you see here, the Jordan Belfort, Rainmaker sales, Rainmaker deal making is dead. It's over. It's been over for a long time, and we've moved from being push sales driven to very much what I would call a pull cycle, or some people might refer to it as demand side, but it's about self-buying and people doing a lot of self-help and self-learning in their buying cycle. And so we're going to talk about that as the impact that it has now on fintech deal making, and how has that come to be. And as we like to say, this is the only plug that I'll be putting in today. I'll put in the plug for this nice environmental green Marvin Gaye vinyl that you can find at your local Target. That'll be the only sales pitch of the day. I'm a big fan of this. But like we say at Cornerstone in our research, what's going on? So let's talk a little bit about what's going on in deal making in fintech. And I'll start with what's going on with this whole idea of self-help. And that is the first success factor that I'll cover for you in this, the rest of these 20 minutes. And then we'll just open it up for open chat and have Mike maintain the volley here with me a little bit. The first success factor that we have to share is really use cases. I think for many of you, you've put a lot of time into this. If you haven't, boy, you're going to. This is sort of I like to sometimes refer to as the slide that scares children. There's a lot here going on, but basically, if we look at the success factors of fintech from my perspective, at the very, very heart of things is, do you have a market that you know well? Do you have something unique that helps drive a pain point? And the way that is demonstrative to the market, whether it's in demos, sales presentations, or just the passion that you're sharing in the industry, is in use cases. And so it's the first warning sign in our bank work at Cornerstone. When we go into a bank that's looking, let's say that they're interested in investing in fintech, or they're interested in pursuing fintech initiatives, we'll always ask, what are your examples? What are your use cases? And if we don't hear those, and that's very common. I think it was Don McDonald actually from MX who recently said something around, we just have to get better as fintechs and fintech providers, both challengers and mature solution providers, at dishing up the use cases, at making a case for very, very specific ways to solve problems. Because in many ways, the banks and other fintech organizations that you may be deal making with aren't very good at it. And it turns out many of us may have taken this for granted. It turns out that coming up with use cases, and for many people, is kind of hard. We really enjoy working on it. It's something that I've worked on most of my career, either as a banker, as a fintech, or as an advisor. But it's just something that if it's not there, it has to be put into place, and it has to be well thought out. It doesn't have to be a lot of use cases, but those use cases then drive the capabilities that you're then building with your various partners to serve that market. So the use cases are just really, really important. And there's a tip that I would offer around use cases from when we talk to different fintech organizations that seem to be having a better go of it in terms of getting higher value and better deals without such hard work. And that is stop using what I would call the multivitamin approach to use case design, which is where you have, 15 different problems that you solve, and you've got 15 different use cases, and we solve efficiency, and we also solve revenue growth. We're a dessert topping and also a floor wax. It's sort of like the multivitamin that does it all. And the reason for that is that I would just say closers and people that are doing better at deal making and just better at resonating are people that solve very, very specific, concrete pains. So not just aspirin, but like Dones, specifically aspirin or pain reliever designed for back pain. You're trying to get very, very specific because it's credible. Your solution or a fintech solution that you're investing in may solve 15 different problems. The problem is that it's not believable. The story doesn't resonate that you can actually solve 15 problems. And even if you could, nobody can remember 15 of anything anyway. So it really pays to be specific here. So we would say, for you to do really, really well here in the first success factor in fintech deal making is have extremely specific, concrete use cases of problems that you're solving, and they have to be pain. They cannot be nice to haves or vitamins. And the worst of all worst is where you're a vitamin that's a multivitamin. You do not want to be a multivitamin. You want to be a very specific type of pain reliever as you're putting together your use cases and capabilities. And also ultimately when you're putting together your pitch and your story around that pitch. So that's the first success factor. As we go to the next success factor, and so I'm seeing here from Scott Mills, any tips on uncovering problems when prospects don't intend to share them? It's a great question. I got to tell you, Scott, I'm a big believer in questions and speaking out, even if you have to, is to provoke your audience, even to disagreement. One of the things I found when we're advising fintech clients at Cornerstone is there's this belief that head nodding and people being passively positive is a good thing in a session. And we actually don't find that to be the case. We think most of the time that bankers or other partner companies are nodding their head, they're doing it out of courtesy, or it's what I would call the Japanese head nod, which is they're acknowledging you. What you're really looking for is either disagreement, debate, clarification, maybe a different opinion, so that you can really get into it. So an open-ended question is fantastic if you can get them to offer up responses to that but if you can't get a good open-ended question, or you can't get your audience to take the bait on an open-ended question, I think provoking the audience with an emphatic statement, even if they disagree with it, disagreement is a better way of engagement and getting them more vested. So, and Mike, I see you coming on here. So
yeah, I have a question for you, and this might help others as well. Do you have a specific use case that you can think of as an example for the audience of what a use case is and what a specific use case is?
Right. Yeah. I think when I'm thinking specifically of a recent conference where the guys at I think it was Dan O'Malley at Numerated. That's not a plug for Numerated. It's just that he just happened to do a really good job of just dishing up a very specific set of pains in the small business to commercial loan origination process, in between the loan origination process and the spreading process. And for many of you, that may sound like a very arcane, process, or something very, very specific that would only be limited of value to a very, very small audience. Good news is if you're Numerated and you're Dan O'Malley and you're talking to the right people at the right bank or fintech, that specific conversation about how spreading doesn't work well with loan origination, or how it doesn't then feed into doc prep systems or whatever, that specific type of knowledge of solving that pain is very real and very acute. And you'll normally get a lot of people talking about how bad it is at their bank or their fintech organization. And so I say be very, very specific. It also helps that, it does actually help that Dan O'Malley in that particular case was a banker before. So it's almost like some of it comes natural. So your choice of who your presenter or your chief revenue officer or your industry representative actually comes into play here, because it's a little bit easier for some people to come up with those examples than others. But I would say very, very specific is better. And descriptive words are your enemy. Buzzwords are your enemy. What you're looking for here is 8th grade, 9th grade level, simple, straightforward Hemingway's English, because that's generally how chief lending officers or payments officers or buyer personas at financial institutions and fintechs talk. They're informal, direct, and plain spoken. So that's probably the best I can do on that one, Mike, but we can pick up the conversation as we keep going here. So that's the first success factor. Now, moving into the next success factor, getting back to the sell me this pen example of Jordan Belfort of just ramming product, the spray and pray, ramming product down throat of buyer. Then I would say that the new success factor that we see a lot more of is the use of influence content. Now, this grid that I've got here on the screen for you is something that I've used, and there's an article on it around the messaging in the market at GonzoBanker, the GonzoBanker blog. And it's a free article, so that's no plug. It's an article. So, but if you look at the content lever here, what you're looking to do with content, with just, you're looking to move, like most consultants, the upper right hand quadrant is the good place to be. What we find is that a lot of organizations that don't really have a worldview, or they've not learned about their market, or have very specific concrete use cases that they're trying to solve, will oftentimes not have much to talk about. They just simply want to show you how cool their system is. And that's just not good enough for most people that are listening to pitches or meeting with people and taking precious time to do that. That is the Ron Burgundy, asleep at the wheel snooze fest. It's not compelling enough. And the truth is that most of the time that consultants like Cornerstone get brought into engagements, many times bankers and fintech people have already been looking at a lot of solutions online, or they've been doing self-help, or looking up things on YouTube. And so the content that you have that's already out there that shares your passion for solving these pain points, if it's interactive, if it's shareable, it's about the knowledge and passion that you're bringing around that knowledge. Having that developed in advance, leveraging third-party organizations, could be Cornerstone, but it could be lots of other organizations, to increase the reach of that, whether it's in the media, or whether it's just, you're writing good stuff. I mean, going back to the beginning of Cornerstone, GonzoBanker was started as a blog just to share, and content just to share thoughts that we had on the business. You have thoughts on your business, share that knowledge for free, get it out there, and get it in the right hands of people, because oftentimes your solution is getting partnered and bought before you sort of ever land at a demo or at a partner meeting. And so this is a huge factor going forward, whether it's white papers, videos, research reports that you're having put together. It just shows that you care and that you have passion for the space. Mike?
Yeah, there's a question on the chat for you to explain a little more what you mean by delivery here.
Sure, you bet. So what we mean by delivery here is that you have a mature, think about your website, your mobile assets, your social delivery. So think not just about your fintech company's maybe Twitter handle or LinkedIn profile at a corporate level, but what we're talking about here is at a personal level, that the management team, if you're a startup fintech, it's probably the founder, maybe a couple of other people, but all of those people are engaged socially, and that you have that content hitting website, that it's reaching the right types of people, and that you're using analytics and things like retargeting programs to hit the right types of people. Because one of the things that we find is, if you're kind of like lower right-hand quadrant here, meaning that your delivery is really strong, and you're getting all this content out to people, but your content is weak, it can actually be kind of annoying. Right? It's kind of like when I get emails sent to me from organizations that are talking to me like I'm a bank, and I'm trying to solve a problem for a bank, and I'm not a bank. I'm not a banker. I'm a consultant. So their delivery is not particularly strong in that case. So just be very, very careful on that, because typically a more mature delivery and better reach is better. But if your content is weak, you can ultimately end up annoying people. So you're looking to go upper right here, which is strong content, strong delivery through web, social, mobile. So I hope that answered the question there to Con. So thanks for that. So that's the second influence factor. A little bit of time check here. I better pick up the pace here a little bit to honor my 20 minutes. But I think, Mike, you're jumping in too. So as long as we don't ice over the hour, we'll be in good shape. But the third success factor that we have is the well-honed pitch. As one of the fintech CEOs said one time to the team, as well as to the advisor, tell me where I have mustard on my face. I want to wipe it off and move on. The thing about the pitch, and there's lots of, I mean, if you just go out and Google best pitches, you're going to find all kinds of great resources that people have shared and content on how to do a great, industry pitch and a great solution pitch. But I think the way to look at this is, for all of you who are strong developers and you take pride in your product development or your coding and your or low code development, is treat it like when you're developing software or developing a system. Do it in sprints. Hone it. Keep beating it up. Like, treat it like UX design, where you're just really beating it up dozens of times until you get that story and that pitch down to a really, really well-honed, example-rich, but not overly cluttered pitch. And so just a few thoughts to share with you. I mean, every pitch in every company is a little bit different, but I say just a few things that I would share on things that we've seen in well-honed pitch. And then I'm going to share some examples of traits. I'm not going to throw anybody under the bus or whatever, but just some traits of duds versus hits that we've seen from recent pitches. But, have you done the discovery to know your audience? Are you doing a generic pitch, or are you pitching to a very specific fintech partner or bank where you know that organization and you've done some background, you know what their priorities are? Have you even asked them what their priorities are, and then sort of played some of those back to them that tells them that you're listening? Speaking plainly with confidence is actually one of the ones that we have to counsel people on the most, because especially people that are coming in from outside the United States to pitch fintech in the US, this is an informal, plain-spoken market for the most part. And so anyone who's trying to sound smart, be academic, throw down some buzzwords, it doesn't resonate as well as just a good, solid example and concrete example, like I mentioned earlier, Mike. And then the other thing is decluttering in terms of the style, and that is, you may in fact have 8 differentiators or 13 differentiators, but it's not going to matter, because nobody's going to believe that you have 13 differentiators. I've never found anyone that had really more than 3 or 4, and most of the time it's 1 or 2 that are real standout differentiators. In some cases, there isn't one. There isn't a differentiator. But decluttering these for impact is really, really important, because if you have a 60-slide pitch deck, for example, and I have seen those, I can almost guarantee you've got too much, like probably by a factor of 5 or more, depending upon the audience. You want to connect with the needs of that audience that you know. I cannot overemphasize that, especially if you're working on below, say, the top 5 banks or large, potential partners like maybe Square or PayPal. When you're dealing with the mid-market, in the US market at least, names are power. A lot of people will say, well, don't be a name dropper. But let me just counter that and say, you definitely want to be a name dropper. You don't want it to be gratuitous, but you definitely want to use specific names of either peers that are doing something, peers of theirs that are doing something, or if you're a brand new solution provider where there isn't anybody using your solution yet, be right up front about that. But give them some people that they could aspire to be as peers, whether it's in another industry or whether it is something that you've spelled out that they could be. The point is that names and specifics are very, very powerful. And the lack of names comes across candidly as maybe you're not customer centric. Maybe you don't care that much about your clients. When you're using names, it sort of is a code that tells the audience you have references, you have people that can back you up, and you care enough to be very, very specific, as opposed to using broad brush, grandiose terms about a solution. Also, the biggest issue, especially if you're dealing in deals that involve consultants, is naming specific types of integrations. Not just a company like FIS or Jack Henry or Fiserv or Q2 or NCR or whoever those solutions providers are, but to the extent that they have named types of integrations, so by name. So it's not just the name of the company, but it's the name of their middleware or the name of their API or the name of whatever. These integrations and your knowledge of them, even if you haven't finished them yet, just your being able to know that they exist in specific ways. The worst enemy is just saying, oh, integrations, no problem, we've got APIs. Everybody says that. And it leads people to disbelieve you because it implies that you're suggesting that integration is easy. And integration is never easy. Like, it never is easy. And then lastly on this, Mike, illustrating the impact, we don't think it's always a great idea to obsess on ROI because you can kind of get lost in the details and models and who's doing the math. But just obsessing on the outcomes shows that you care, and we just find that it helps a lot in the pitch. Mike?
Yeah, I just wanted to overlay one thought here that I think puts an exclamation point on what you're sharing. And I think this is a specific challenge for a lot of us in the fintech industry, where we've got sexy products that are doing cool things and look neat. I think it's great to remind everybody the client or the prospect does not care about us or our solution.
Yeah.
No matter how cool and sexy it is, they care about their problem. And I think remembering within the pitch that we need to be looking at this from their perspective versus just telling them how cool we are is something totally appropriate.
And it's hard too, because you're right. You're rightfully very proud. You should be very proud of the efforts that you put into the developing. But what you don't want to do is suffer the you've done all that work that you've done to develop it, and then it just doesn't resonate. Because what we found is that the first three things that people care about are, number one, who else is doing it? Number two, what systems are they connecting to? And number three, is it cool? Like, cool is number three. To your point, the problem is the center of the conversation, but there's at least two other steps before the cool step. And so it's a good point, Mike. And I just want to share a few traits. And I think you guys can relate. If you've been to some of the industry events, you can put some names and logos to this. I tried to be gracious here, not throw a dud at anybody by name. But look, if you would look at any of your pitches and you would say that they have any of this stuff here on the left, will you still get a deal? Of course. Are there huge companies out there that are doing some of the stuff under the red zone here that are getting deals? Of course there are. There are other factors. But all things being held equal, if you're being pushy and basically telling everybody to buy your stuff and to join us, and you appear desperate to sell, if you're telling and then showing, let me tell you more about what you're going to see here coming up here. No. Just show it. Like, don't tell them how easy it is. Show them that it's easy. I think it was Derek Sutton who recently was on stage and said to somebody, I'm sorry, Derek, this is an impromptu, but he said something like, don't take our word for it. Just go download it and try it. It'll take you 3 minutes. It's easy. You're basically daring people. That's the provocative. You're just daring people to download it while you're sitting there talking to them. That's interactive, and it's check it out. Go check this out. You don't have to believe me. You don't have to join me. You don't have to buy me. Just go check this out. Here's a resource over here. Here's an example over here. Here's an outcome over here. Examples are your friend in the pitch world from my vantage point. So that's our third success factor. Our fourth success factor is your chief revenue officer. Now, I'm sharing this Freakonomics podcast with you. This is another plug has nothing to do with Cornerstone or anything else. But if you're looking for a great podcast that I think any chief revenue officer would really appreciate, a good chief revenue officer, many of you might appreciate, it's the Freakonomics podcast. Why? Because they're not just talking about geeky economic stuff, which they do, but they also focus on behavior and unintended consequences and behavioral economics of how people make decisions and unintended outcomes and those kinds of things. And that is the environment that you want your chief revenue officer. And many of you that are, when you're first starting out, your founder, your CEO is the chief revenue officer. I think this is particularly important for many of you who enter that stage where you're actually bringing on a head of sales or a chief revenue officer. Let's not confuse a strong individual seller with a strong chief revenue officer or organization builder who's thinking about things like, what are the barriers? What should some of our early clients be looking like? And what should be the traits of our go-to-market team and our pitch? Those are the things that I'm always constantly looking for. So, hey, check out the Freakonomics podcast if you haven't already. It's a really good thing, but I just would say your choice in whoever it is that's your chief revenue officer is absolutely pivotal. One last tip on this that I would leave you on the chief revenue officer is, depending upon what stage you are in your journey, try not to have a chief revenue officer who's focused on getting you from, let's say, 0 to 130 clients, or whether that's B2B or whether it's B2B fintech or whether that's banks. You're thinking about someone who can get the first 3 clients and get from 3 to 13. And then, depending upon the scale of what you do, what I've generally found is that once a fintech organization has the right balance of, let's just say, your first 13 clients, getting from 13 to 130 or whatever your goal is for world domination isn't that hard. Like, you've already got a certain amount of momentum, but it's getting from 0 to 3 and 3 to 13 that I find that the right chief revenue officer and the right perspective really is pivotal in this in the process. And then the 5th success factor, and then we'll just open it up here wide open on the chat, is prioritizing the best targets for what you do in fintech. What I find a lot of times is fintechs put so much deliberate work into the building of their solution, but not a lot of thought into who should buy it. The thought is, well, of course, whoever it is that has money and is offering to be a partner and an early adopter would be good. And what we've generally found is that can be a recipe for disaster, because if you get the wrong initial clients for your first 3, getting from 3 to 13 and from 13 to 130 is much more difficult. If you get the right 3 first clients, getting to 13 isn't as hard of work, and then getting from 13 to 130 or whatever your world domination is much easier. I would say that generally there's a perception when fintechs are working with me on advice that the size of the institution, there's always some asset size grid. Let's look at banks by asset size, or let's look at other fintech partnerships by the organizations that they serve by some kind of size. And I've got that here in red because I know that's publicly available data and we all use it a lot. But I would just say, look, be careful. We don't find institution size to be always the best predictor when you're segmenting. And so a few of the other areas, and we do a lot of different segmentation when we're helping people out, just like when a bank is doing segmentation for consumers or businesses. And some of the ones that I've seen work better than institution size are the business model of the bank or the business model of the fintech partner. So you're talking about, are they mainly commercial? Are they small business? Do they have specific niches? Is their delivery model a little bit different? They don't have branches, et cetera. So it's more the business model than it is the size of the shop. The other systems used, what oftentimes people will say is tech stack. What's your existing tech stack? That's a big determinant of whether or not someone's a great target for your offering, only because integration can be so hard Risk appetite's another thing, and not just their risk appetite for working with younger or early stage solution providers or fintech organizations, but also just many of you may be bringing novel ideas to them. So it's not just that they're working with younger, perhaps more risky in their mind organization, but the actual technology that they're deploying or the new means of extending credit or whatever is riskier. Lastly, I think what we've tended to say is that institution size leads to what resources they have. And we don't find those things to be related well, especially in parts of the mid-sized bank market that have relied on maybe the third parties or their core provider for a lot of their integration heft or other talent. Is if you can find out in your early discussions how many people, how many developers they have, how many people that basically know where the bodies are buried in the organization. It's important because you can run into a really, really large asset size organization that has nobody around that knows anything about how things work together. And for many of you, that's going to be a challenging partnership if they don't have good, solid resources. So those green ones are really, really high predictors. And then some of these others here that you see, like, do they have investments in other fintechs, or have their leaders worked at other banks that have used certain types of fintech? Volumes, oftentimes, like volumes of loan applications or volumes of payments. And then there's always seems to be a wild card or two out there that we run into. I'm seeing here a question here for, or maybe a statement here from Stan Viner. Here I see something from Scott Mills as well. How often do existing system contracts play into fintech deals to FIs or other fintechs? Actually, it plays into it a lot. And oftentimes what we find is that if an organization, a bank in particular, hasn't had someone internally or an advisor or someone really managing all of their various contracts and renewal dates and termination dates and things of that nature, as well as their service level agreements and terms and conditions that say things like, maybe they've signed some type of an exclusivity agreement and didn't know it or didn't remember it. Those are really important. That's a really important point, Scott, that can actually play into, it doesn't necessarily play into how interested they will be in your fintech organization. The problem is that they can be interested in you and then have a problem at the altar, if you will, where they have every intention of working with you, and then they forgot that they signed this thing 3 years ago that restricted their ability to connect the hip bone to the leg bone or whatever. There can be gotchas, let's put it that way, and you definitely want to make sure that when you're qualifying organizations, that's why the systems that your prospects and partners are using is important, because there are some patterns there among some of the systems and types of systems. Let's see, Stan Viner question for fintechs that intend to sell their services to both banks and credit unions. They need to remember that banks and credit unions often have very different sales cycles, mainly due to ownership structure. Great point. The governance, knowing the governance of a bank versus a credit union. And it also has an impact on their risk appetite. One is more earnings focused and perhaps more financial focused. One is more experience focused, et cetera. But it's a great point, Stan. Right. So that's the fifth. The fifth success factor is the prioritization. So how do you do this? Segment the market on all the attributes that you can, get through various data sources. So segmentation is one of the things. We then take segments and then look into things, we call them archetypes. It's basically clusters. So think, urban bank focused on niche commercial lending using, Encino and Q2. I'm just throwing out, like, that combination could be an archetype that is a perfect match for your fintech organization. That also could be the worst for you, could be, right? So we just sort of dig into those and stress test various scenarios of these archetypes to kind of get you to the answer of where to start first. I think the other thing is that this then guides your, what I would call your Cosmo quiz, your qualification process, your sales qualification process, your underwriting, if you will, of your time. which is when you ask these questions, hopefully you're documenting them, and it helps you determine, even if you can't get the data publicly, you can basically ask the questions and get as smart as you possibly can. So that's the fifth success factor. One last tip on this that I would just point out. Even if the way that your system integrates with other systems in the mix is easy from your perspective, my recommendation to you is stop saying that integration is easy. Almost every fintech and solution provider that we run across in their conversations starts off with this idea that integration is easy, and it doesn't resonate at all, especially with bankers, because they know that integration is hard, and it may not be hard for you, but they believe that it's hard for them. All the systems that you see on the screen here, this is just a breakdown across several categories of all the different systems that a bank or a credit union would have, that they oftentimes have to be connecting together behind the scenes. There is so much integration that has to happen. And they've had so many bad experiences trying to get this done, or failed or missed delivery dates because of integrations. It's still one of the bigger challenges. My recommendation to you is, even if your integration is very, very easy, maybe talk about what you've done with your people. Keep technology out of the conversation. Talk about how your people work with other people to try to make it less difficult, and so there's been this kind of idea that, well, we have this whiz-bang widget that just basically, it's just magic. It just happens. And nobody believes the magic. So part of it's a perceptual issue. Like I said, your system may integrate very easily, but people won't believe it. You're going to have to hack that another way than just telling them that. Showing them that, letting them see for themselves, or talking about people as opposed to technology is the hack. And lastly, I would just say, and then let's just go right into the questions, is 2 takeaways. There's a couple of reports. They're on our website. They're free. One is for if you're a more mature fintech solution provider, there's a study on both sides of the table of these relationships. If you're more of a early stage, there is a report there on bank fintech partnerships in the State of the Union. I think you'll get a couple of good nuggets from these, because I think one thing is we can just learn from one another. And with that, Mike, I think what we should just do is let's just open it up for any more conversations, questions, disagreements, or anything else in the garage.
Yeah, for sure. So I would invite anybody that's out there to put some questions in the chat panel if you have any, or there's some great comments out there. You can share those as well. I think part of what is so great about the NFO is this is us all sharing. It's not just Sam. So if you have wisdom that the rest of us might be able to benefit from, please share that, and we can discuss that here as well. But Sam, I'm going to throw a question out to you. You talked about the archetypes, you talked about integration, you talked about partners. All of those things point to the fact that we have to play together, right? We have our common clients, but at the end of the day, we are these different organizations need to integrate. They need to play together. Any best practices that you've seen for earlier mid-stage fintech organizations for developing relationships in a successful, healthy way with partners?
Yeah, I will say there's, and I remember, I started out in the tech business, and so I too want to solve problems with technology. I'm not suggesting that there aren't, but there's just absolutely no substitute for good, knowledgeable people, whether you're home growing them or whether you're plucking them out of the industry, that know the business and know the providers, knowing, just taking the effort to know the systems, knowing the connectors, knowing the people that are behind the connectors, getting their contact information, following them, and basically lean away from generalities and buzzwords and frameworks. Funny, for me to say that, I just showed a bunch of frameworks, but I would say in that particular issue, lean away from that, lean into individual micro knowledge about individual providers, individual interfaces, individual API types, just knowing lots of specifics. And the truth is, I don't think there's a shortcut. I think you have to hire people or get them spun up, whether it's at industry events like this or wherever but very, very specific details. And I think the other thing is that I think bankers and other fintech partners can kind of tell when you've done that. There's a different conversation that you can have with people when they already know, what, the connector is, the connector types are at FIS or Jack Henry, right? It's a different level of conversation that you can have than when you're kind of glossing it over and just saying, oh yeah, well, we have this, this service bus thingy that, it fixes it all. Like, no, that's not likely. It's not likely. So what I find is that the other trait here, Mike, that comes out is that when you have people that you've hired, it's code that tells the market that you care about the details and that you have funding, or that you have resource, or that you're using your funding in ways other than just blasting off advertisements, right?
Yeah, no, that makes a lot of sense. Hey, there's a great question out here, especially for you, Sam, I think. Donna asks, any suggestions on how to create partnerships with payment consultants who already have relationships with prospective clients? So I think you're probably a great one to address that sort of question.
You bet. Yeah. I personally think in the banking and fintech market that LinkedIn is an absolute gorilla of I'm also on Twitter, but I think that just there's no, now I wouldn't just sort of go blindly looking for connections to people that you don't know, but I would simply say identifying who you believe or finding somebody who knows who those people are, that could be it too. So it's either finding out or finding someone who knows who those people are, identify them, reach out to them. In most cases, like Brandy Gregory, who's the leader of our payments practice at Cornerstone, I mean, she just gets direct notes from people all the time. What works? A quick 1 or 2 sentence email that says, hey, this is who we are and where we're coming from. What doesn't work? 5 paragraphs with a glossy attachment, that's probably not going to work. So there's a little bit of an EQ factor here that goes on that says, how much time are you asking for from someone? And then what I found is helpful after you've gotten to know the individual players. It's not so much about the firms as it is the individuals. Consultants can be very different, or advise even within firms. So get to know the individuals that are impactful to payments. And then what I would say is follow, share, debate, disagree with them. It's okay to disagree. Actually, a lot of times consultants are looking for a good argument. It's like, it's almost a sport to us sometimes. And then what you're aiming for, generally what I find is, depending upon how far along you are in your scaling, is you're looking for probably a briefing, like some type of a short session where you're updating the consultant and her or his peers at the firm, if they were in a larger firm, maybe once or twice a year. And then if you could almost think about on the off quarters that you're not doing those things, maybe just a brief email. And again, what are the 3 things that we said that financial institutions that hire consultants normally care about? For starters, if they're hiring a consultant, you can figure they're already risk averse. Very likely that they're risk averse. They want to know about who else is doing something. So peers. They want to know about systems that are integrated. That's systems, peers. By name, names of clients, names of investors, names of systems that are being integrated. And then thirdly, cool stuff that you're doing. So I hope that helps.
Yeah, and I would just overlay that again with the concept of even payments consulting, even payments consultants aren't totally pro bono, right? They're not,
Right.
they have a game, they have a value. So as you go and try to build those relationships with payments consultants, once again, it's not just about how cool and sexy your product is. It's about what value can it deliver for the payment consultants as they serve their clientele. So continuing to remember to put that client hat on the person you're trying to talk to. Great question out here.
Real quick, Mike. Something else I would just suggest is, and this isn't just about Cornerstone. This is just I would advise you on talking to all payments consultants is find out what their guiding principles are, or what their barriers are, because different consulting firms will work you in work. I said work you. They might work you too. They will work with you in different ways. They may be very, very independent, where maybe they'll work with you on some type of a white paper or something, but that's it, or you could speak at their conference or something, or like something like that. Or they might be, they won't even return your call because they are trying to be purposefully distant, all the way down to, there might even be consultants that I would argue that they may not even be consultants. They're more, kind of hired guns, if you will. So there's all variations of consultants, just like there's all variations of fintechs.
I'm going to pop through a couple other questions here for you, Sam. The first one, I'm going to go back to something you talked about earlier. Just really quickly, can you give an example of interactive content? When you talked about delivery, just really quickly, what's an example of that?
Oh, good interactive content would be LinkedIn videos, YouTube videos, where you are encouraging people to share it. Or respond back to the company where where there's lots of tagging going on. Tagging is an excellent technique, assuming it's not gratuitous and you're not, ticking somebody off in the process. But if you've gotten to know several people, you can sort of do that type of interactive content. I think the other thing, interactive content that is good, what we're doing right now, if you can get one of your investors, one of your early stage clients, maybe an industry consultant or researcher or someone else, and create a valuable conversation around a very, very specific topic. And this is important. It doesn't work well when it's about you, because generally what I find is that people smell a rat. Like they're like, okay, wait a second. This is like a sales pitch that's kind of like a webinar, not really a webinar. And so what I find a lot of times is find out who your buyer persona is at a financial institution or a partner, and then find out things that they care about that are tangential to what you do. Maybe not exactly on the nose to what you do, but tangential to it, and then start a conversation. A good example of this that I saw was, the guys at Strategy Core, Dave DeFazio, who created a research report. He's working with a colleague of mine, but one of the things that Dave did was he didn't want us doing a lot of the public work. He wanted to do that himself, and I thought it was really smart. He did a lot of the lifting, and he started a conversation around, what would happen if Amazon offered a checking account? That was the throwdown. Now, that wasn't directly about what Dave's company does, but it's in the ballpark of what Dave's company does. And it started a viral conversation around Amazon, disruption, competition. And I would suggest to you that it was pure gold because it was valuable. It was interesting. And it furthered the conversation and it helped people, but it wasn't an on-the-nose pitch.
All right, Sam, at least two more questions here. The first one, how do you see fintechs utilizing reseller and referral agreements to expand their indirect sales channels? And I'll maybe just put a little, I'll make that open-ended and I'll say, what are you seeing working well there as well?
So let me play that back to me again. So what do I see working well?
How do you see fintechs effectively utilizing reseller and referral agreements to drive their indirect sales channels? Grow their business.
Right. No, I think it's very, very effective. I mean, and I guess the way that a couple things. One is when you're using an indirect sales channel, there's sort of two things that I think that are kind of success factors. One is the reseller or the referral, whatever that arrangement is, are they hungry? Meaning, are you a pimple on what they're doing, or are they hungry? Is it a significant part of their message, and either a significant part of their revenue or a significant part of something that's important to them, or are you just one more thing of 100 that they're working on? The second thing, and I think this is important, getting to the first one, is, do you have good content? There's a tendency to think that content and white papers and videos and speaking and all that is really for the end buyer. But I actually think, and I'm trying to think of the name of the industry consultant that said that sometimes the target is the messenger. Okay, the messenger in this case is the target. So your content has to be designed for the partner. And I oftentimes find that getting a person dedicated, depending upon your scaling, where you're at, a person dedicated to those partnerships so that they're absolutely working that, fertilizing that ground with the partner on an ongoing basis, maybe even a dedicated person to that partner, like it would be like maybe national accounts work for a large fintech. So hope that's helpful.
Good stuff. Good stuff. Maybe the last question here, and I think this maybe gets to the very heart of a lot of what we all are doing. And it's as simply put as this: how do you get an FI to meaningfully engage in these types of conversations?
How do you get them to meaningfully engage? I think there's one word that comes to mind, it's vesting. And that is, if you're too desperate and needy, and you appear too desperate and needy, it's like romance, right? The vibe is off. You're pushing, right? Not good. You have to get the pull cycle going where they're pulling you in. The only way that I've found to really do that well is through a combination of content and relationships, and getting working the network. But it's basically the romance side of this, and making sure that they stay as vested in the process as you are.
Awesome. Sam, thanks so much. I know we're at the top of the hour, and the voice is going to come in over me in just a moment here, but I want to say, Sam, thanks for putting this content together, and thanks for sharing, and wanted to just thank everybody again for joining. I hope you're finding benefit in NFO, and we're looking forward to seeing you at the next one as well.
Thanks, everyone.
Thanks so much, Sam, for an information-packed session, and thanks to all of you who joined us today. As a reminder, the recording of today's session will be available soon on the NFO's YouTube channel. Be sure to join us for the next presentation in NFO's Growth Garage on Tuesday, July 19th, when Jane Barrett of MX and Kim Ford of Fiserv present their updates on government impact on fintech and financial services. We just put the registration link in the chat, so check that out and get in early. And the registration link will also be available soon on the NFO website at nationalfintech.org. Thanks again for joining us, everyone. Have a great day.